Brad Thomas here with the Forbes Real Estate Investor. I'm joined with Scott Peters. Scott is the CEO of Healthcare Trust of America. Scott, it's good to see you today.
Good to see you, Brad.
Scott, it's been almost 10 years since your company formed as a non-traded REIT, and now just over 3 years since you were listed as a public company. So let's talk a little bit about what your company has done from the beginning and how the company has grown over the last 10 years.
Well, first off, it'll be 10 years in May, and we're very proud of that. And it'll be 4 years public in June, and we're also just as proud of that. More importantly, we're proud of our returns to shareholders. We've returned, as of relatively the end of the month, 10% annual return. So that's something that we think investors are very happy with. And we're also fortunate to have done 2 or 3, 4 things importantly during that period of time. The medical office building space. We're a dedicated owner of medical office buildings, and so we're a dedicated real estate investment trust. I think that's very important in today's environment. 2, we manage our own assets, and in 2010 we started our in-house management, and now we're 95% in-house, and we have over $3.5 billion of invested assets. So we're a major player in the markets that we're in. 3rd, markets. We like to think that we go and we pick markets that we get core critical mass in. And that core critical mass leads to performance, it leads to understanding of the market, it leads to relationships. And 4, we think that the performance from a cash flow basis is very important. Our NOI, 3% same store growth, we're now into 12, 13 quarters, and that's just every quarter you build your cash NOI. So, and then 5th, I think when I think that the important thing we have done, we've kept our leverage very low. A lot of companies, all company goes through ebbs and flows, and the key to those ebbs and flows are low leverage. And we've done that, and so we've been very fortunate, and we find ourselves now moving into the second set of 10 years, hopefully, and looking forward to that.
Great. Scott, I cover this bracketology series, which is a comparison of all the REITs in various sectors. One thing I've noticed that in the healthcare space, MOBs have performed very, very well compared with all the other subsectors within healthcare. What exactly, what's causing that, and why has this medical office building kind of come to the surface as a top performer?
Well, it starts that medical office buildings are core critical real estate. You've got on-campus buildings, where the hospital is, physicians need to be there. There's synergies within that campus. Second, you have the Affordable Care Act, and that's really changed healthcare over the last 4 or 5 years. It just started really getting implemented in 2012. We're seeing healthcare systems now move into that, their strategy. How are they going to continue to provide healthcare for everyone? But the most core aspect of medical office buildings is the macroeconomic trends. Who uses medical office buildings? Well, it's outpatient space. That means that in the Affordable Care Act, hospital systems, physicians need to put their health care in the most affordable location. Well, that's medical office buildings. And so the ultimate user needs the space that we're investing in. Then you have the age. There's 10,000 individuals a week turning 65. Everyone knows that as you get older and continue to get older, you need more health care. You need more uses. You see the physicians more often. You go to the outpatient locations more often. So performance, it isn't susceptible to reimbursements as much. So you don't have the risk of government reimbursements. Healthcare systems have learned how to be more productive, more efficient, move space to cost-effective locations like MOBs. Physicians, they've grouped themselves together. So now there used to be one physician or 2 or 3 physicians in a space of 1,500 square feet. Now you see physician groups of 30 to 100. And they've bundled their services together, maximize their efficiencies. Great space from an ownership perspective. And for investors, I think it's in the very early innings. I think that the Affordable Care Act changed the financial fundamentals of medical office buildings. It changed the healthcare space. And we were fortunate enough to be in a position to start investing in it and continue to invest in it.
Sure. I want to touch on the durability of this company a little bit. In full disclosure, I'm a shareholder in HTA. I've been a shareholder for a couple of years. I want to talk about specifically, Scott, if you would, the balance sheet and how safe your balance sheet is today and how you've been able to achieve this investment grade rating with several different rating agencies, I believe.
Yeah, well, first of all, just low debt has always been our philosophy. We're at 30% right now, and we've probably been between 30 and 35% since we were founded, and that's over 10 years. REITs, real estate investment trusts, their purpose is dividends. It's to return income to shareholders, and the best way to keep that safe is to keep your debt low. So we continue to do that. But the fundamentals of medical office also leads to that. Is you have occupancy. Our occupancy is at 92%. Even in the worst of situations, back in 2008, 2009, the Great Depression as they call it, occupancy for medical office buildings were still in the high 80s or low 90s. There was very little foreclosure on medical office buildings. Physicians need to service patients. Patients get sick, whether it's a good economy or bad economy. And so the fundamentals of healthcare, medical office buildings, really gives a very secure income stream. Therefore, it's a very secure dividend. And if you keep your leverage low, you have two or three very good components.
Good. Finally, I want to touch on the dividend. That's a really important metric for us retail investors. And I know your company, what's interesting, I'm looking at your history, you've grown the dividend a tad last year, but you haven't grown as much as your peers. However, you've outperformed your peers by a very wide margin. So what is the secret to that? What is you've got a very modest payout ratio of around 80%, I believe. So what is the secret in terms of your dividend growth model? I know every year you evaluate the dividend in terms of its growth, but what can you tell us about the safety of the dividend today for investors?
Well, we are about 80% from a coverage ratio, as you pointed out. We've started raising our dividend now 2 years in a row. We will continue to raise our dividend as we continue to make strong investments. 3% same-store growth NOI, that continues to generate cash flow for our shareholders. But the most important thing that I look at is that as an investor, I want long-term sustainability of performance, and that performance comes from great investments. And if I can make great investments with your dollar, which you originally put into my stock or whatever you invested in, and I can take some of that dividend that I could pay back to you or put into just as good or better performing assets, then that creates value. So we continue to look at dividend every quarter, every year. We will continue to raise our dividend, but we also will continue to reinvest that excess cash into profitable medical office buildings to generate long-term performance. So we like to continue to be productive with people's equity.
Great. Scott, thanks so much for your time today and letting us all understand a little more about your company and Healthcare Trust of America. Thank you so much.
Thank you very much.